Forex Compounding Calculator is the Forex trading tool that calculates the profit of next trade with profit added from previous trade to the initial account balance. At the end, you get exponential returns on initial investment. Forex compounding is the process of using the profit you make on one trade and adding it to your initial account to increase the profit on the second trade. That means if you open one trade on $10,000 account balance and that trade is a successful trade, you will make $200, which is 2%. Here is more detailed explanation. In Forex you trade Forex currency pairs like Euro-USD currency pair, where you predict the price of Euro-USD move up or down on the chart. That means if the Euro-USD is equal 1.1234, the price can move up to 1.1235 or down to 1.1233. And when you make the correct decision, you make money. The amount of money you make on that trade should be defined in percentage. In our example, I have used 2% of profit on each trade. So at the end, I have $10,200 in my trading account. To compound this amount, I will use $10,200 as a starting balance on my second trade instead of $10,000, which was the starting balance for the first trade. Now I have $10,200 as a starting balance, and if I plan to make 2% on the next trade, I will make $204. You can see that my profit increases on the second trade because the starting account balance is larger. And if the second trade is successful, I will have $10,404. You can see that in two trades I have taken with compounding, I will have 4.4% with 2% on each trade. It's not $10,400, which is 4%, because I have used my profit on the first trade and included in the starting account balance. This is a compounding effect that increases initial account balance, which increases profit on the second trade. Here is a summary after two trades, so we can move to the third trade. We can see that in the first trade with 2% of $10,000, I have $10,200. And on the second trade with 2% of $10,200, I have $10,404. In the third trade with the compounding, now I have $10,404 as account balance, and the trade with 2% of profit will give me $208.08. And when I add that amount to the total account balance, I have $10,612.08. After three trades, I have $612.08 of profit, which is equal to 6.12%. Now, let me explain the math behind the compounding. Here is the Forex compounding rules. To get the results, there are few rules you need to have in mind, or you will not get the results you see in the Forex compounding calculator. First rule is always use the same percentage of profit on each trade. If you use 1%, then always use 1% on trades you open. Second rule is each trade you open should be positive if you calculate compounding for each trade. If you use a time period instead of trade, then you need to be profitable in that time period. That period can be day, week or month. Third rule, each profit of the previous period should be added to the account balance and calculate percentage gain from that account balance and not from the initial account balance. So if you have started with $10,000, then the next period will include profit plus initial balance for calculation. How to use the Forex compound calculator? Use the calculator by entering three important variables in the calculator, and those are: first variable is initial investment, second one is percentage of profit, and the third is time period. Enter these three variables in the Forex calculator compound and click on the button Calculate. You will get the results in the table where you can see how much you would get after each time period. With initial investment, you define what will be the starting account balance. The Forex calculator compound will start the calculation. This initial investment will be increased in each time period with previous period profit. and that increased investment will be used in future calculations. Have in mind that Forex calculator compound works with profit only. If you lose money in one time period, the table with results will not be valid. You will need to enter a new account balance as a starting investment and make the calculation again. The Forex compounding calculator expects that you increase the investment each time period. That means if you start with $10,000 and you use a monthly time period, you need to make money that month, not to lose the money. So you need to make at least the percentage you have defined. If that is 2%, then you need to have $10,200 at the end of the first period. If you make less, for example, $10,100, which is 1%, then you need to make the calculation again with the Forex compound calculator. And then you will have $10,100 as initial investment. The second variable you need to define is the percentage you will make per each period. That can be 1%, 2%, or any other percentage. But that means percentage of profit of account balance. In my case, I have used $10,000 as initial balance or initial investment, and I have opened 3 trades. Those 3 trades can be in a day or in a week. Let's use month as the time period because monthly period is mostly used in calculating profits. Usually, all traders want to see how they have traded when the month ends. So the time period is a month. You select the percentage of profit in a month. That can be 1% per month or 2% per month, or any other percentage as I have already mentioned. Let's see now what is a Forex compounding calculator. It is a tool that calculates the profit of next trade with profit added from the previous trade to the initial account balance. The formula behind the compounding calculator is here. P is principal or initial balance. In my case, that is 10,000. R is percentage or a rate as decimal. That is the percentage. In my case, it's 0.02 or 2%. And the time period I have set here as a 3. Time period can be day, week, month, or any other period you want to calculate compounding results. Let me show this formula on an example where I had $10,000 as initial balance. So P is 10,000 and 2% of profit on each trade, so R is 0.02. The time period will be the number of trades. In my case, I had 3 trades, so T is equal to 3. Now here is the calculation. When I make each trade separately, you will see how I have got the above results. Here is the step-by-step of the Forex calculator to compound with the compounding rules I have mentioned. Here are the rules again. First rule is always use the same percentage. Second rule is each trade you open should be positive. And the third, each profit of the previous period should be added to the account balance. First trade with 2% of $10,000 gives me a final result of $10,200. Second trade with 2% of $10,200 gives me the final result $10,404. And the third trade with the 2% of $10,404 gives me $10,612.08. Now, where is the importance of a Forex compounding calculator? As you can see, when you added the profit of previous trade to the calculation for the next trade, you increase the profit on the next trade, and you use the same percentage of profit. If that is 2%, it stays the same all the time, but the profit increases. Compounding in Forex increases the account balance, so that is why it is important to use it in Forex trading. If you take a look how the compounding in Forex looks for a higher time frame period, then you will see that compounding in time gives you huge returns. And by huge I do not mean linear increase like this, where I have used 30 trades with 2% profit calculation. Let's check linear calculation. You can see how important compounding in Forex is when you use linear and compounding calculation. In 30 trades, or 30 days, or 30 months, you define which time period you want to use. You can see how the amount will change. Linear calculation gives you an increase in profit of $6,000. So, if you use the 30 months period, you will have $6,000 on a $10,000 investment. When you use compounding calculation, And when you use same conditions as with linear calculation, and that is 2% of profit, $10,000 initial investment and 30-month period, you get this. In 30 periods, you get $18,113.62 on $10,000 investment. You can see how important compounding calculation is in Forex trading. It gives you huge returns, which you could not get with linear investment. What is the main disadvantage of compounding in Forex? Main disadvantage of compound interest in Forex is that it is hard to have a constant percentage of profit in a certain time period. It's not easy to find a strategy that will give you profit each month with a guaranteed percentage. If that is easy, then all of us would be rich with Forex trading. And for example, if you have a time period of a month with 2% target, you would need to open at least one trade that would bring you 2% of profit. That would look like this. One trade with 2% of $10,000 equals to $200. If you open two trades, then both trades would need to be positive, or at least one positive and second trade without loss. That would look like this. First trade with 2% of $10,000 equals to $200. Second trade, 2% of $10,000 equals again $200. And totally we have 4% of $10,000 equals $400. In second case, when one trade is positive with 2% of profit and second one is without loss, we have first trade, 2% of $10,000 equals $200, and second trade, that is trade exited at the same price you have entered, so there is no loss and there is no profit. In total we have 2% plus 0% equals 2% of $10,000 gives us $200. But if it happens that you open two trades and one is positive and second one is negative, you would end up with first trade, 2% of $10,000 equals $200. Second trade, minus 2% of $10,000 equals minus $200. And total we have 2% minus 2%, 0% of $10,000 is $0. One thing to note here is that you need to pay attention not to lose on each trade more than you will gain per trade. That means the risk you will calculate in the trade with 1% of profit cannot be more than 1%. If you have a risk-to-reward ratio 1 to 1 or 1 to 2, you could end up at 0 at the end. But if you use a risk-to-reward 1 against 0.5, then you would lose more per trade than you would make when the trade is positive. This is a bad trading decision, so I would not suggest going into Forex trading as a beginner with a risk-to-reward less than 1 against 2. What are pros of compounding in Forex? The main advantage, or pros for Forex compounding, is the result of the investment after a certain period, where you make more after each month with the same percentage. In the example from the graph, you can see that each month with the same percentage of profit, you end up making more. For example, let's take the profit you make with 2% after the first month with your initial $10,000 investment. 2% of $10,000 is equal to $200. And let's take the profit with 2% after the fifth month with the account balance after 4 months. 2% of $10,824.32 equals to $216.49. You see, after making $200 after the first month, you will make $260.49 after the fifth month. That is a difference of $16.49 without any changes, but only using compounding calculator in your trading. What is the best compounding frequency? The best compounding frequency is weekly frequency that gives you 4 times more than monthly frequency. But the best compounding frequency depends on the trading results you can achieve. If you have a good trading strategy with good results, then you can make a lot of money quickly. Let's put numbers on the table to explain to you which compounding frequency is the best. I will assume I can get 1% per each trade I open. And that means I do not have any bad trades. To give you a rough overview of how that would look on a weekly basis, check this out. If I open 1 trade per day throughout the week, I will make 5%. Monday 1%, Tuesday 1%, Wednesday 1%, Thursday 1%, Friday 1%. Now, if I take the same results for 4 weeks per month, I would end up with 4% at the end of the month. So 4 multiplied with 1% per week equals to 4%. And when I take same scenario and put it on a monthly basis, I would get this. 1 multiplied with 1% per month gives me 1%. Here is a table that shows you what I mean by having different compounding frequencies. The table shows you 3 different compounding frequencies. Daily compounding frequency, each day you make 1% and next day add this amount to initial balance. Weekly compounding frequency, each week you make 1% and next week add this amount to initial balance. Monthly compounding frequency, each month you make 1% and next month add this amount to initial balance. Annual compounding frequency, each year you make 1% and next year add this amount to initial balance. In the first column, which is the daily compounding frequency, you have the amount of money after the first month. Each row represents 1 month. That way you can see where the difference is between how much money you can make each month if you compound with daily, weekly or monthly frequency. Second column shows you weekly compounding frequency and the amount of money you will have at the end of that month. Third column shows you monthly compounding frequency and how much money you would have at the end of that month. And fifth column, where the annual compounding frequency is, shows you 1 year with 1% of profit. It is a small amount, but it is a very conservative approach with a conservative return. Which is better, compounded daily or annually? By simply checking the end of the year, you can see that you would make more than 1000% if you have a daily compounding frequency compared to annually. You see that annually compounding result would give you only 1% return on $10,000 investment. So, if you can, the best is to have daily compounding frequency. But is that really possible? Can you make 1% of profit without having a bad day? Hard, but not impossible. Is it better to compound monthly or annually? Now, if you compare monthly return with annual return, you can see that monthly return has more than 10% of return and annually has only 1%. I can say for sure that I would like to have a monthly return more than annually. And I can say that monthly returns are possible to reach if you have a good trading strategy. What's better, compounded monthly or daily? Monthly or daily compounding shows you that daily compounding is better than monthly with more than 20% of profit at the end of the first month. But if we compare daily compounding with monthly compounding at the end of the year, we get this for daily compounding. You can see that daily compounding has more than 1000% of profit compared to more than 10% of profit on monthly compounding. What's better, compounded weekly or daily? Let's compare weekly compounding and daily compounding. At the end of the first month, we would have 4% of return on weekly compounding. If we check daily compounding at the end of the first month, we get this. So the daily compounding with more than 20% of profit is better than weekly compounding with more than 4% of profit at the end of the first month. And finally, let's see, how do you become a millionaire with compounding interest? You become a millionaire with compound interest by investing $10,000 and make 10% each day through 49 days. Here is how that would look. You would invest 10% each day and then add that return to initial investment. After 49 days, you would have $1,067,189.57. This approach would make you a millionaire with compound interest. If you like this video, click the like button and subscribe. See you next time.